Hello and welcome to Chapter 11, Creating Financial Statements from the Introduction to Business Textbook. Now that we know what financial statements are from the previous chapter, now we're going to go into the process of creating comprehensive financial statements for your business. As a business owner, you don't have to be a financial whiz or have a CPA. It will help, but it's not necessary to be a business owner. But you have to know the basic foundations and the definitions of financing in business. It will really go a long way to have a successful business. So one of the things that we're learning is how to create financial spreadsheets, collecting the financial data that you need, and analyzing your financial statements. So one of the first things you do to begin is you have to estimate your startup costs. Every single business owner will be different, right? If you are a business that is pure digital, whether you're a consulting firm or a digital marketing agency, right? All you really need is just a Wi-Fi access and a computer per se, compared to perhaps an auto mechanic shop, which will need a lot much more physical equipment to get the job done. So if applicable, are you going to have land and construction costs? My suggestion is if you're starting out a brand new business, I don't highly recommend to build a brand new building from scratch. It is extremely expensive. I would first suggest to perhaps rent or lease a space first. That way you can test your business. If your business becomes successful and then you want to go purchase your own building or build your own building, go right ahead. But in the very beginning, either rent or lease your space. Equipment, again, what type of equipment will you need? Will you need furniture? Or you need computers? Or you need specialized equipment? Every single business, depends on different equipment. Like, for example, if you're going to go start a food truck company, right? You need a food truck and you need equipment within that food truck. Inventory. Again, what type of inventory do you need? Leasehold improvements, right? Again, that's of course if you're doing reconstruction. Organizational costs, right? Legal fees, depending on the type of business. Do you need permits? Do you need licenses? Depending on the type of business you have, you're going to need special permits and licenses. So you're going to have to get all that cost associated with what it's going to take to start up your business. Rent and lease, that's pretty easy to find online. You go online, you Google, rent or leasing spaces in your area. You can get that. Organizational costs, you can look up that online as well. Inventory and equipment, again, find that information online. Let's go back to a balance sheet, right? And how to structure that information that you're going to need for that. Your assets, as I mentioned, things in your company, right? Your cash that you have on hand, the equipment, the inventory, building, that's if you own it, any leasehold improvements, organizational costs. Liabilities, right? Notes payable, for example, which is a formal agreement with specific terms, including interest rates and repayable schedules that you have. That's, for example, perhaps if you have a bank loan of some sorts that you promise to repay, that would be notes payable. Accounts payable, right? It's informal debts. The amount of money to a business owes to its suppliers for goods or services purchased on credit. So that is what accounts payable is, and any other debts that you may have, whether it's a business credit card or some other type of debts that you may have. And of course, owner's equity is any money that you've invested into your company, that is owner's equity. So remember, assets equals liabilities plus owner's equity. So to determine your capital structure, right, how much money do you need to borrow, your borrowing capacity, how much money on cash reserves do you have? Remember, you need to have cash on hand. Cash is king in business. Equity requirements, right, additional capital needed beyond what is borrowed, and of course, collateral ratios. So in this ratio here, approximately 40% inventory value, your building value, and your equipment costs. Again, your collateral ratios is going to determine by the type of business you have. So this collateral ratio is perhaps it's one of those businesses that, that has a brick and mortar place, perhaps construction equipment, a restaurant, or another sorts, or a medical facility. So how do you build an income statement? Income statement is built by a number. Here are some factors, right? Your sales revenue, so total income from goods and services sold. Whether you sell t-shirts, whether you sell tacos, whether you sell hamburgers, or whether you sell consulting services, that is the sales revenue that you're bringing in. And so all of that income that you've sold, whether it's physical or whether it's digital or whether it's, consulting services, that is the sales revenue you're bringing in. Your cost of goods sold, so any direct cost of producing the goods or services. So for example, if you make pizzas, right, you sell the pizza, what did it cost you to make that pizza, right? The dough, the ingredients, the sauce, everything that went into producing that particular pizza. That, of course, would be your gross profit. So everything that you did, your revenue, minus all the costs you did, that is your gross profit. Now, it's not over yet. Now, from that gross profit, you have to minus all your operating expenses, the salary, the wages of your employees, even your contractors, the rent or the mortgage, if you own the building, the mortgage, the rent, if you're renting a place, the utilities, the insurance, and every other operating expense that it takes to run your business. Then that is your net income. Hopefully you have a good profit, or you perhaps have a loss after all expenses. Now, having a loss after all expenses is not uncommon among businesses. There are businesses that have a trajectory of losses for a number of years or for a number of months. But of course, you have to make a trajectory towards getting profit. And so again, your sales revenue may be high, but then at the end of the day, how much are you bringing in net income? So expense categories in the income statements, as you see, are some labor costs, right? Wages, commissions, or bonuses if you offer that. Contract labor, payroll taxes, you don't want to forget that. Workers' compensation, employee benefits. Operational costs, if you're renting, leasing, or own, if you have a mortgage on that. Supplies, utilities, maintenance, insurance. Other financial and other costs, right? Depreciation, legal and professional fees, advertising, licensing, interest expense. That's why for your operational costs, if you can lower that, you don't have to always, you see what you can lower or take out. When it comes to wages, perhaps work with your employees on labor costs. For example, if you have a salespeople, perhaps lower their salary and up their commission. Maybe put some people part-time or hire some contractors instead to lower your costs. Again, cost of goods sold represents direct cost attributed to the production of goods sold by the company. So again, for a restaurant, the cost of goods sold is the ingredients. For retail, it's the cost of purchased inventory. So that goes the difference of the cost of goods sold. And of course, cash flow statement is, what's your cash at the beginning, your cash flow, your cash inflows, and then of course what you have to pay and how much cash you have at the end of the day. It's very important that you manage to see how much cash you have, because if you don't have cash on hand, it's going to be very difficult to operate your company. So without cash, your company can run into the financial red. So remember, cash is king. So some cash flow statement linkages. Again, your cash flow is determined at the beginning of your balance sheet. It's determined in your income statement, your loan amortization, and how much cash you have at the end of the day. The reason why a lot of businesses fall into trouble is because their cash flow is very low and they don't have enough cash on hand to pay, whether it's debts, employees, whatever it may be. They run into trouble. The number one factor that businesses always have to make sure that they have money for is payroll. If they don't have enough cash for payroll, they're in big trouble, because then people are not going to get paid. If people don't get paid, they're going to leave, right? That's why sometimes other companies that have a hard time going through payroll may not even pay their contractors on time, which can then put you in can put a business in a major red situation. So let's look at the sales estimates for a company. Their annual target is about $1.2 million of sales that they're targeting. Without seasonal adjustments, they're making about $100,000 average. Of course, there is a peak in December with retail, and then of course there's a lull. So one of the things about profits or businesses is sometimes there are season highs and lows, right? For some companies, they have a high season and a low season. For example, if you are a company that does shoveling of snow in an area that has a lot of snow, there can be a high season where you make a lot, have a high peak, and then of course you have a low when the snow is gone. How do you have to find other ways to make money. So again, what are your seasonal sales adjustments? You're gonna have to adjust your books when you have a high season and a low season. The trick for a business is to find out how you can adjust for when sales dip during the low season. For example, a lot of restaurants that are around college campuses, their high season is during the semester. So typically between late August and late November, and then of course starting back in January up to late April is their high season, because that's when college students are in town. Then of course the summer is their low season. So typically June and July, May, June, July is their low season. So companies have to figure out how are they going to make above average or just normal income. That's why a lot of those typical restaurants in those areas probably have adjust their hours in the summer, offer more catering services to perhaps summer camps in the area. They just come up with different ways to make sure that they adjust for their low seasons. You can run financial simulations. There are companies out there who provide budget software to run simulations to see, okay, how do I adjust for my sales? What do I need to cut costs? Projections. If I make this amount of money, make this amount of sales, how much money could that bring for my company? Where do I reduce cost? So you have to connect sales estimates to market reality, right? So here are some 3 examples that the chapter offers, which is really good for you to determine. A tanning salon example, a restaurant example, and a retail. Each one of these industries measures or different ways of sales estimates. For example, a tanning salon with an average sales of $180,000, which is targets about, if you're charging about an average of $6 per tan, you need to have at least 30,000 tans annually in order to meet that target of $180,000. So on average, a customer has to tan at least 30 times per year, which should need 1,000 customers. Now, if you perhaps you either get more customers or you charge more to make sure that you meet your annual sales target. Because if you want to get people to come in the door at least 30 times a year, you're going to have to provide very good quality service or get them enticed to continue to come in the door. A restaurant, for example, in order to calculate, they have to, how much is a person spending per check? How many times can you turn over a table? For example, a table turnover rate is where a restaurant that, has, you come in and you sit down to eat, right? The host or the hostess sits you down. How many times can that restaurant turn over that table on a nightly basis? If they can turn it over 3 times or 4 times, that's pretty good, right? If they can only turn it 1 or 2 times, they're gonna have to make sure that check size is pretty significantly high in order to make up for that loss. And of course, that's why a lot of restaurants don't like people sitting in that table for 3 or 4 hours, because they need to make money. Unless they're continuously to buy drinks or more food, that's one thing. but that's why restaurants want to turn over tables as many times as possible in a sitting. That way they earn more money. And of course, a retail, right? How much foot traffic do they need? So for every 100 people that come into their retail, out of those 100 people, how many are going to buy a product or from their retail, right? Aligning financial projections, again, what's the industry trends? Where is the industry going? Target customers, has a target clearly identified and quantified? What's your competitive advantage? And how do you differentiate? Just some key takeaways for financial statement creation, right? Link all your financial statements for consistency. Have market validation. Again, what's the market reality? So, for example, if we go back to the tanning salon, for example, if the industry average is $15 per tan for individual, and you're charging $30, let's be realistic. You have to come to market validation. What does the market say? Again, going back, you have to have realistic projections. And that is chapter 11 from the Introduction to Business textbook, Creating Financial Statements.